Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. We're on a mission to become Australia's most trusted property podcast. And in our weekly 2 cent segment, we'll take a plain English look at the big three property news stories of the week. I'm Pete Wargent and I'm joined by Chris Bates from Rask. G'day, Chris. How's things?
Pete, life's good. What's been happening? Excited for you to come back to the land of Oz next week. And looking forward to seeing you next week as well. What's been happening?
Yeah, I'm looking forward to it. I'll be knocking around Sydney for the next week or two. Then I'll be in Melbourne. Of course, it's grand final day coming up. So hopefully Brisbane can make the finals. My kids are so excited. I don't think they realise that this stuff only comes around once every so often. I think, being new fans to the game, they think they win every year. But we'll see how we go. I think Collingwood are favourites. Looking forward to being around the traps over the next few weeks and then back up to Queensland in 3 or 4 weeks' time. How about you? What's your week been like?
It's funny. As a kid, I used to always hope Liverpool would win the league, and they only just won it 2 years ago. So I went through almost 30 years of pain. So, they've got a lot of pain ahead of them if they think they're going to win it every year.
Don't even go there as a Spurs fan. They've still not won the league, and I'm 46.
Yeah. I think it's been good here. My dad just visited up from Melbourne. We're up for the Gold Coast for a week before. It's interesting seeing all the developments, which I think I mentioned last week. And head down, bum up for the next 8 to 10 weeks till Christmas, which is spring's already sprung in Sydney. It's hot as, I think it's 30 degrees next week. So I think Property Summit's on with the AFR today. So there's going to be lots of interesting stories coming out of that, which we'll have a chat about next week. So what's on the agenda this week, Pete? Always lots of stories.
Very nice. Yes, there's some interesting stuff happening. I think we're reaching an interesting point for the housing market in Australia. We've obviously seen a rebound that's been much faster and stronger than expected. But now I guess we're coming into the spring selling season where there should be a bit more stock to choose from. And the impact of those interest rate increases starting to be felt as well. So the main 3 news stories this week. Firstly, business insolvencies. It's a 15-year high. So a lot of those zombie companies are being taken out by the increase in the cost of capital. So we'll take a look at what's ahead in terms of employment and what it all means for the housing market. Secondly, in the commercial property space, Morgan Stanley reports that Australia's office towers are set to take a major hit to valuations. There's been some changes in what happens in and around our CBDs over the past few years, of course. So we'll take a look at that. And then thirdly, PropTrack reported rental vacancies continuing to fall as temporary visas in Australia surged to a record high. Rental vacancies are now the lowest on record. So the rental crisis hasn't really gone away. It's kind of turning into almost like a rolling issue, a rolling crisis. So, Chris, let's start with the business insolvencies story. So this was a report. ABC did the piece. Business failure rate worsens, calls for government action. More than 15% of Australian businesses in the past 12 months have failed, the worst rate since the global financial crisis. New data from the ABS shows that half of the businesses started in 2019 were closed permanently by June this year. And over the 4 years to June 2023, 35% of all Australian businesses closed their doors for good. So, Chris, I guess one of the things that's happened is that we don't have zero interest rates anymore. There was also a period there where really failures weren't being allowed to happen. We almost had a moratorium on things like people going into mortgage arrears, which obviously impacts small business. We had, tenants couldn't be evicted very easily. We had interest rates were held right down at the zero lower bound. But all of those things are starting to change. And now we're starting to see, I guess, the snapback, and a lot of small businesses are going insolvent. And it's the worst we've seen in 15 years now.
Yeah, I guess it sort of goes against what we're potentially seeing from an unemployment rate being so sharp, right? And the lowest it's been in 50 years. I think it's the opposite, right? So I think that it's a bit of a worry, right? Small businesses, what are they going to do once the business goes under, right? Is there layoffs? Is there redundancies? Do we start to see, unemployment start to rise because businesses are going under? What does that mean for their other assets, their business debts, their personal debts, etc.? So if it's a lot of new businesses, maybe not a lot of staff members, but I mean, is this sort of, or even just a big mortgage player just pulled out, recently? I think that with labour costs so high and margins so tight, I guess businesses they're just holding on right now and they're not actually making a lot of profits. Do they just pull the pin? And that would be my take. I think it's definitely something to watch, right? Is the unemployment rate, right, might be saying actually everything's rosy. There's not many big issues here. But if we start to see businesses start to go under, is that sort of the canary in the coal mine, Pete? That would be my take on this article.
Yeah, so looking into the stats, transport, postal and warehousing was the most vulnerable industry, with nearly 2/3 of businesses opened in 2019 no longer in existence by June 2023. I think the other thing is that clearly retail is going to struggle. We saw a big boom in spending, especially things like cafes, restaurants, takeaways through the pandemic as we handed out all of that stimulus cash. But now the cost of living has increased, the cost of capital or interest rates have increased, and that's seeing a lot of consumers starting to tighten their belts. And I guess things like the hospitality industry is really going to feel the impact of that. And I suppose from a property market perspective, there is some various data that tracks all of this. SQM looks at things like distressed sales, which for the time being anyway, they're still pretty low, to be honest. And as you said, the unemployment rate, the time of speaking anyway, still relatively low. I think the forward-looking indicators, I saw Justin Fabo from Macquarie Bank, he looks at some of the indicators, things like the number of people applying for each job, the ratio of job vacancies to people who are searching for employment. Yes, those forward-looking indicators suggest actually the labour market's not as tight as it was, and we're heading in a sort of a softening direction. I mean, at the moment, as you said, the unemployment rate's still low, but a lot of people coming into the country now, a lot of people are tightening their wallets. And yeah, I think some small businesses, which probably had a relatively easy time, strangely, for a couple of years there, in terms of availability of capital and zero interest rates, well, a lot of that's really starting to bite now. And I guess... so I suppose we're seeing small business failures. And I suppose the other thing is in construction, Chris. We've seen a lot of developers going under over the past year or so.
Yeah, we've had a client, it's actually had two builders go out on him, actually. The first one went bankrupt and the other one went bankrupt on him as well. And it was a sketchy story in the end. They almost paid the builder who was being harassing for money, even though he knew he was going to be insolvent because he wanted some money in his own bank account. It was a dodgy situation. So absolutely, we've seen that firsthand. I think the zombie company is actually going to play out. I think ultimately the big worry here, I think, with unemployment is that if people are worried about their jobs, or they're not as certain, or they know they can't just switch around, they're more likely to stick to their current jobs or take less risk with their lifestyle decisions. And so we're seeing a lot of our clients who typically would just go for it, whether it's a lifestyle shift outside of Sydney to Central Coast or Byron, for example. A lot of them are wanting to just say the safe option, and just because they're worried about if they do have to switch jobs, how are they going to get hybrid work, or and potentially not even switching jobs because they're worried that potentially they could lose their jobs. So they're not going that worker mobility and the wage increases. We're not seeing distressed selling. When those last couple of rate increases happened in May and June, that was a really stressful time. We were seeing almost daily emails from clients really worried that how high were rates going to go, because they were surprised after a few months of rates pausing and then two increases. However, with the last 3 months not going up, we're not really getting emails from many clients that are really concerned about their mortgage. And more of our clients are rolling off their fixed rates. And there's not a real fear around that rates are going to keep on going up, I guess. And people are just trying to hang on, I guess, knowing that potentially rates could go down in the future. And yeah, so I think that, and that's playing out in the market. When you said, Pete, at the start, that it's an interesting time coming into spring, we absolutely have seen a shift in our buyers who are pre-approved or who are starting to start beginning their search. They're willing to make offers now, and they're wanting to get things sorted because they're worried about things running on. So it's almost the start of FOMO, where people are trying to get things pre-auction, and they're worried that if they miss out, that they might not be able to buy in a few months' time. And we had double figures of purchases last week, and actually some really bigger ones as well, which that 2 million sort of plus market really froze up for the last 12 to 18 months. That was the tightest market. The least transactions were at the top end. And so, we think those wheels are already spinning, and people are wanting to get ahead of the wave rather than wait for rates cuts to potentially come.
Chris, before we crack on to story 2, what do you advise, or what do you say to clients who are thinking of building their own home? I guess in the context of those business failures. I had a client this week who looking for somewhere to buy in Melbourne. There's not really much stock on the market, so they're thinking of either buying a knockdown or buying a block of land and building themselves. But how do you mitigate that risk of developers going under or being quoted one price and then massive cost overruns, changing the whole dynamic? Is there anything that people should do in terms of due diligence, or is it just a risk that you have to take on if you're building?
It's an interesting one. I think even the best builders have gone under in recent years. I can think of a client who was using a very reputable builder, doing very high-end apartments, and that builder went out under just even a month before it was almost finished, right? And so I think even in builders, sometimes they have individual projects that are on individual companies, and so they could be great in 95% of their projects. So this could just be a basket case, this one, and they could have real issues. And so I think it's really hard to protect yourself with the builder. I mean, I guess it's the contract's really important to make sure it's a fixed price contract and you've really talked it through and you understand, the obligations and the sunset clause and all those sort of things. So, but I mean, a lot of people would say, just pick a great builder, but that hasn't protected a lot of people in the last couple of years. So it's hard, right, Pete? It's really hard to say there's an easy way just to guarantee you're going to get this amazing outcome. Obviously, picking a reputable builder over someone who's potentially not been doing it that long and hasn't got a great track record and a big base of staff, etc. What do you think, Pete? How do you think the best way to play this?
Yeah, I think actually the ABS stats themselves show one thing, and that is we know that the relatively new businesses are always at much higher risk of failure. So I guess longevity is one of the things you can look for. No guarantees, of course, but a business that's been around for 20 years and through a few cycles generally will have a lower risk than one that's been around for 3 or 4 years or less. I guess that's it's like what they call the Lindy effect. The longer something's been around, the longer it's likely to be around. Well, that's certainly one of the things you can do is to look for builders and developers who've been through a few cycles and have some experience of managing cash flow and projects, rather than the relatively newcomers, I suppose, where the risk might be higher. But I guess it's just a time where risk is elevated anyway, because there's been a big increase in the cost of materials and trades. And there's some real challenges out there in the industry, as the ABS is reporting. So, Chris,
I guess another thing on that, we saw a client, and he wouldn't mind me saying this, he probably drove too hard of a bargain. And he's run very successful businesses. He's done very well for himself, but in his build, he applied his business logic into his negotiation with getting a builder. And I think he got that contract at a price well under market. And so I think he shot himself in the foot. He basically priced the builder out of a profit. And very quickly that builder realized that this isn't going to be a profitable job. So he underquoted it and he over negotiated, and then it left at a point where the builder basically walked off the job. So I think, and he ended up having to find another builder and end up costing similar to what the original quotes were for the builders he had, the 2 or 3 other quotes he had at the start. And so I think you've also got to realize that having those real frank conversations with the builder up front and not try to just go for the cheapest price and cross your fingers and she'll be right, because when things don't go well, and that was a real nightmare situation because the bank's stuck in a rock and a hard place. You've got to get another builder in. They've got a whole new loan contracts. It's they're going to want to pick a job up halfway. They're going to want a premium for that, for the risk and, for the work that they've done. Is it done right? Is the slab being laid right, et cetera, et cetera. So, yeah, you definitely don't want to be swapping builders. And so sometimes it's better off to go with a reputable country. Maybe it costs a bit more. Maybe there's a bit of an extra margin you have to pay, but that gives you certainty that you're going to get through this. We are talking clients out of doing builds at the moment. You said, how do we approach this as well? There was a client this week that was very gung-ho on doing a build in regional New South Wales, and we just did the numbers, what they're going to pay for the land, the costs to get this land, all services hooked up, and then do the build and the risk and the time. And there was just very little money to be made in it versus just buying something established. And I just really asked them, is it worth it? Is it worth that stress and the risk to potentially have zero financial reward at the end of it? Yeah, you might have a home, but, would you be just as happy in something established? And they're actually going down the more established route, to be honest, now versus actually, so we've kind of stopped them taking on that risk.
Has been an interesting thing over the past year or two, where looking at units and apartments in places like inner city Brisbane or Perth, and you couldn't build them at today's prices. You're effectively buying established stock well under the replacement cost, which I guess is one of the ways that people can de-risk an investment in an asset. Anyway, interesting times there, and yeah, definitely still some challenges ahead in the construction sector. So, Chris, second news story of the week: office towers to take a major hit, a Morgan Stanley report. So the ABS reported this week that the value of Australia's dwelling stock rose 325 billion in the June quarter to be back above 10 trillion. So effectively, the housing market has recovered all of the declines through the pandemic, driven mainly by increases in the mean dwelling price in New South Wales, up 32,000, and Queensland up 26,000 in the June quarter. However, Morgan Stanley reports that office tower valuations could fall by another 10 to 15%. So from their report, some major office towers could take another 10 to 15% hit to their valuations, making them the weakest links in a commercial property sector that's under pressure from higher interest rates. Office probably has another 10 to 15% to go, particularly for some of the more challenged assets with poor tenancy profiles and in non-prime locations. That's from the co-head of investment banking in Australia. They've backed this up with a few charts. Australia's vacancy rate for offices, it ran as high as 20% in the early 1990s recession. We've never seen anything like that since, really. Even in 2009, we're only around 10%. But now, I guess a very different profile, Chris. Vacancy rates are pushing 15% for office space, about 14.1% over the 6 months to July 2023. And in particular, some of the CBDs, not so much Sydney, but some of the other CBDs, Melbourne, Perth, Adelaide, are seeing very high vacancy rates. And that's clearly been driven by the working from home phenomenon, which has persisted, I guess, at least for 3 days a week for a lot of workers now.
Yeah, I mean, I think everyone we're probably pretty up to date with what's causing this is, absolutely the appetite for office space is reducing. I think maybe for AAA grade towers that are, the eco-friendly towers that are freshly built with more open space, they're very much in higher demand. But the towers that are a bit more run down, that are a bit much like a call center, right, where you've just got desks and a small kitchen, like. It's not exciting to get people back to the office. I think there's people are struggling to get people back into the offices in those. Well, I can just do this from home. And so I think there is this washout. And whether these get moved into residentials, it's really hard. Not every building's going to be but I would say that the commercial sector, like if there is some repricing, they've gone through other cycles before. The GFC is a prime example where, REITs got absolutely smashed. And maybe, parts of the REIT portfolio are doing well, but maybe office towers aren't doing so well. And maybe, super funds have to write down their assets, and maybe some big end of town or some, syndicates that, accountants have set up for mum and dad investors in their superannuation funds. Maybe they're going to get hit. But I think a lot of the property market is owned by sort of mum and dads and, couples and singles. And, that I don't think they own a lot of commercial property exposure. And yes, their super fund does a little bit, but they're very diversified in that. They haven't got all their eggs in commercial property and office towers. And so while that is getting hit, it's maybe not hitting everyday Australians. It's maybe just hitting the upper end of the market. And I would still argue they've got the land value of these assets. And so, yeah, maybe they haven't got a tenant. Maybe their whole value is falling. But I still think if they're a good tower, well located, they're still holding the land. They know that's what's gone up a lot in value over time. And but now they're forced to potentially do something with that land. If you've got a tenant in there paying the rent, well, we can just hold on the land. I'm not forced to make any decisions. But if it just gets untenanted, I can't lease it out. What do I do? Do I fix it up? Do I retrofit it? Do I, convert it to apartments? Do we knock it down? Do we sell it to another developer that combines sites? And so I don't think it's a bad thing. I think it's just potentially going to allow us to use our land more efficiently and, potentially create more opportunity in the future for a better city.
Yes, definitely. It's changing the cash flow profiles for some of those big office tower assets. I think I've seen some stats from the US about just how few office towers are being converted into residential. I think it's often harder to do than it might appear. We have seen some of this around Hyde Park in Sydney in previous cycles, where a former office tower can become a sort of block of units, but it's practically a rebuild to get it to modern standards. So it's pretty difficult to do. I think the exposures here, well, for big super funds, there is some exposure to office assets, real estate investment trusts, and of course Australia's banks as well. But the exposure there is not really like it was, certainly not like in the early 90s recession, where the vacancy rate for offices went to above 20% and all hell broke loose. The exposure isn't so high for banks this time around. Interestingly, Canberra and Brisbane were the only capital cities to record vacancy rate decreases. I think Brisbane, I can understand. There's a lot of interstate migration happening to southeast Queensland, and that's just pushing down vacancy rates there, even for offices. The interesting one there, Canberra, a bit of a change there, maybe some of the public sector getting back into the office a little bit more potentially, but it's a very different market, Canberra, partly for that reason, not so much in the private sector there, and vacancy rates are generally lower anyway. I guess your tax dollars hard at work being spent on office leases. So yeah, interesting one to watch there, but probably some more fallout to come in terms of commercial property valuations. But as you mentioned, it's not across the board. I think some different types of property like industrial, storage, warehousing, medical centres, data centres. There's definitely parts of the market that are doing a lot better, but office space is probably the most exposed by far, as people are changing the way in which they work and live.
And I guess it's just the developers, really looking at the DA approvals and the feasibilities and saying, should we build this as residential? And there is a demand for, that luxury end of the market. Tim Gurner, I think, does a lot in Melbourne. He's coming to Sydney and doing a resi tower. And, I think there's potentially, the desire to live in the city wasn't really there a long time, 5-10 years ago in Sydney, but it is now, right? There's lots of new residential getting built within the commercial. So I think that's what we potentially could see, is a bit more of a diverse pool of assets within our capital cities versus before in Sydney. It was very commercial and not much resi.
Definitely was. So third and final news story of the week, record low rental vacancies reported by PropTrack, which is an arm of the REA group. So this week we saw record high population growth in the national accounts, or that was actually last week, about over 620,000 over the year was the implied population growth. We saw the ABS reports international arrivals hit 1.7 million for the month. That's the highest since January 2020. Also some government figures, temporary visas hit 2.55 million, including a record number of international students. That's a rebound of over 900,000 from the pandemic low. So all of those temporary visa holders who we lost have effectively come back. Now, in terms of what this means for the rental market, PropTrack reported the number of properties available for rent, and this is in the residential space, in Australia has recorded its largest drop in over a year in August, falling to a new record low of 1.1%. Rental vacancies are now 54% lower compared to the start of the pandemic. In Sydney, vacancy rates fell to 1.26%. Melbourne fell to 1.19%. Brisbane 0.84%, while Adelaide and Perth remain the tightest rental markets in the country, with vacancy rates below 0.7% in both cities. So I guess, Chris, this is what I've been seeing. Some of those panicked applications for somewhere to rent have dropped away. So the increase in rents is steadied off a bit. I think people are getting more used to this idea of a more competitive rental market, and some of the frenzy is now finished. But it seems to have now turned into almost like a rolling crisis or an ongoing issue that isn't going to be resolved quickly or easily over the next couple of years. So is that something that you've seen as well?
Yeah, I think for our inflation, rents increases have really dropped off right now. Annual rate of increase is really dropping. So I think that's good for our inflation. But I think vacancy rates and the demand for rental housing just is increasing, right? There's not these all these first home buyers that are leaving and buying property. There just isn't enough properties to buy. There's not enough leaving the rental pool. And I think that there's also a tightening of rental stock. I can think of multiple clients of ours that have sold investment properties in the last 6 months. And, because the reality is when they are under a bit of pressure or they need to free up some capital, whether they want to do a renovation or whether they're looking to upgrade their home, that's been a lot of them where, the only way to feasibly do it is to actually sell their current property or their investment property to allow them to make their next property move. And so when borrowing capacity is really tight and, we're talking 4.5 times income, that means that there's less investors entering the market because they haven't got the capacity to do so. And more investors are going to start leaving the market because they can't afford to refinance, they can't afford to upgrade their homes, and they're forced to, or they can't afford to service the property. So that they're more likely to sell their investment properties than their home. And so I can see as long as borrowing capacity stays really tight, I think there's going to be a real pressure on people who have got investment properties to consider, and I think the market's also allowing them to potentially sell, because if the market was in free fall, a lot of investors would say, well, I can't sell now because I'm going to bake in a 15-20% price fall. Well, if I can just get out now for a reasonably good price, that takes a lot of pressure off. Yeah, I'm maybe potentially not getting the future gains, but I'm not taking on this big loss. And so we're actually seeing that, desire as well, because prices are holding. So, yeah, I can't see this getting better. If obviously this is different cities have got different vacancy. I think Hobart's getting much easier than it has been in recent years. But if you haven't got new investors coming that are greater than the investors leaving, then supply is actually getting tighter. And, I would say there's more investors leaving the market than are actually entering.
Yeah, the dynamics are just all pulling in the wrong direction at the moment. We've got high immigration. We've got fewer investors because we've got that record lending assessment buffer in place. So even people who want to get into the property market and invest for the higher rents are really not able to do so with tight lending settings. But that is also impacting first home buyers, unable to borrow as easily as previously was the case. And they're becoming stuck in the rental pool as well. So combination of all those factors is just putting more and more pressure still on the rental market. Now, Chris, I guess for one thing, it's all very interesting for if the landlord isn't getting the same returns or whatever. But there's a more serious aspect to this. I saw SQM Research put in their release on rental vacancies, which fell pretty much across the board in August. Louis Christer of SQM, I expect the low rental vacancy rate to be maintained. Housing formation will continue to contract in response to the shortages. I'm also expecting a very large increase in homelessness. We also saw in realestate.com.au article, situation for renters in Melbourne is dire, rock bottom vacancy rates. We saw the council to homeless persons, the CHP, said at least 60,000 new public and community housing dwellings need to be built across Victoria over the next decade. We've got a chronic shortage of affordable rental homes, and people on low and increasingly middle incomes are facing the brunt of it. So I think, Chris, for the sort of young professionals and young families, there's definitely a lot of challenges around. But as SQM and the CHP have also said, there's some major issues here at the bottom end of the market, and some increases in homelessness expected as well.
Yeah, on our other podcast, The Elephant, we've been doing lots of topics around this whole problem for like 4 or 5 years, and speaking to lots of people from tenants union to different housing affordability and homelessness, etc. And absolutely, it's at the bottom of the end of the housing market, there's a huge problem. Let alone people who are working, whether they can afford something to rent or find something, and then they can, a high income family even decide to, get a home, can they? So there's issues all up the sky, but obviously you're right at the bottom end. It's pretty dire, right? And the government's coming out and saying we'll build 40,000 new homes over the next 5 years, and the $10 billion fund. Like, all this stuff takes time, and at the end of the day, there's people sleeping on the streets tonight. So I think it's a real problem. I think as what we're going to see out of it, I mean, there is going to have to be some action from the government. I think this is where the Yimbys have got all the forces they need to basically create a big voice and to potentially get some zoning changes, some once in a lifetime changes that they've been waiting for. I think this battle between the state government and zoning changes, and I think that's the thing I'm watching. I think it's going to be a shift if we are going to keep growing our population, which I think that's what the governments want to do, right? And we got all this housing issue. We're going to have to create a lot more supply, and whether that's through zoning, whether that's through making it easier for developers and cutting taxes like they're doing with build to rent, and I think there's a lot of things that are going to have to change to potentially make more things to be built, right? And so I think that's going to be the big story in 2024, because we're still going to have a rental crisis, I believe, and we're still going to have and the housing affordability crisis is actually going to get worse, because I would say prices are going to go up, and we're already even if rates go down, our housing affordability is going to still be off the charts. And so that to me is something to watch in 2024.
It certainly is. So interesting 3 news stories of the week there. So firstly, business insolvencies at a 15-year high, starting to see some smaller businesses and developers and people in the construction sector falling over. Office towers are set to take a major hit, said Morgan Stanley. Office valuations to fall another 10 to 15%. And rental vacancies now at record lows, with capital cities getting especially tight, according to PropTrack. So pretty interesting stuff going on. Before we go, we've got a property masterclass coming up on the 22nd of September in Sydney at the Sir Stamford Hotel. That's 93 Macquarie in Circular Quay. So Chris and I, from 2 p.m. to 5:30 p.m, we're just holding a little seminar there. If you're in Sydney, we'll be doing a property market update. We're doing a bit on portfolio strategy, a bit of a Q&A, and there's some food included as well. So if you're interested in coming along, shoot me an email. petewargent@gmail.com is probably the easiest one to articulate over a podcast. So Chris, really looking forward to that. Always good to do some Q&A and get in front of a few people in the real world, so to speak.
Absolutely, Pete. Looking forward to that next Friday. If anyone wants to come along, would love to meet you. And I wish everyone a happy Sunday. Is there anything else we needed to cover today, Pete?
Don't think so. You can catch me on Twitter, Pete Wargent, or my blogspot is my daily blog, Pete Wargent Blogspot. And Chris, people can get you at Blusk, I think, as we say every week in the show notes. So, by the way, if you've got any property questions you want us to cover in the 2 Cents podcast or in the Australian property podcast more generally, do drop us a line, because we like to try and keep things on the button of what's happening in the real world. So looking forward to catching up next week, Chris. And thanks, everyone, for joining.
Thank you. Happy Sunday, and safe travels this week, Pete.
Cheers.